Hello students, so welcome back to class number 33 on capital budgeting. So here we are going to see some 4 example problems. So one of our students has asked in the comment section. So I request you to post whatever the doubts you have, because you will be in the last minute preparation. Please put in the comment box. This is one such answer for our student who has asked some 4 problems in the capital budgeting. So let's go on with the discussion on the 4 problems. So the first problem is here. The company has installed a machine which is model A. So company has already installed the machine. Okay, to manufacture new product, the capital cost of the machine is 1 lakh. The annual operating cost. So if you are operating the machine for the whole year, the operating cost will be 50,000 excluding the depreciation. So it is exclusive of depreciation. That is a cost without depreciation, and these costs are estimated on the basis of annual volume of 1 lakh. So annual volume is 1 lakh, so I have taken annual volume here, which is 1 lakh, and the fixed cost for this volume is 4 lakh per annum is the fixed cost I have taken it here, which is 4 lakh. Okay, selling price of 5, we already have the volume of 1 lakh. So the selling price of 5 rupee is taken here. So the sales revenue will become 1 lakh into 5, which is 5 lakh. And the operating cost is given as 50,000. So reduce 50,000 from 5 lakh, and the fixed cost of 4 lakh. If you reduce the total cash inflow from this model A comes to 50,000 per year. That is the cash inflow that we are getting. Okay, so this is about the model A. The company has now come across some another machine, and the machine is super model, is capable of giving the same value of production. Estimated annual operating cost is only 30,000. So the selling price is same, the sales revenue is 5 lakh, that is same, but the operating cost is less compared to model A. Only 30,000 is the operating cost. Fixed cost is same as given in the question, and now you will have a cash inflow of 70,000. So just like that, we cannot decide, because the company has already purchased model A and installed. Now you have come across the super model. Let's read out the question. The company has an offer for sale of the machine model A at 50,000 rupees. So somebody outside is ready to take the second hand equipment, okay, for 50,000 rupees. So for you have already installed it, so if you want to remove and take that out and do a proper packing, it will cost you 10,000. That is the removal expense of the model A which you have already installed. You have to remove it, and there is a buyer who is ready to buy your machine for 50,000 rupees. So okay, so if you take the overall investment, so super model machine, the total, so what the company is thinking of doing is, let us replace the model A with super machine. What is the cost of super machine? Yes, it is given in the question, which is 1,50,000. So company is ready to invest 1,50,000, and super model A, which is already installed, they have to remove it, which is de-installation, and sell. So for selling, there is a vendor or buyer already available for 50,000 rupees. So that is the inflow that we will get, and for we will have a removal cost of 10,000. So if we overall put together, 1,10,000 is the net investment that we are requesting to the management. Okay, so manufacturing team has, or the production team, technical team has worked out this detailed plan, and they are placing with the finance department. Finance department, we will review this and we will take to the top management for approval. Okay, in view of the lower operating cost, yes, super model is having lower operating cost. Desire of dismantling the model A and install the super model. Assume model A is not yet started commercial production. The time lag of removal and installation is not material. Okay, so this will not cause delay to the project. Yes, company has sufficient time to dismantle the model A that is already installed, and buying the super model and installing the super model. So there is no time constraint, so they can easily do it. And cost of capital is given as 14%. What is cost of capital? They are going to fund this investment, and for funding this investment, they are having a cost of 14%, like similar to interest. Okay, the present value factors is already given in the question. Okay, but in this problem I will show you how to calculate the present value factor also. In further problems I will not say how to calculate the present value factor. You can apply the same logic. Okay, so state whether the company should replace model A with installing model. So model A will be taken out and model will come in. So which decision, whether it is good or not, and will there be any change in your decision if model A is not been installed and the company is in the process of consideration of selection of either of the two models? Okay, so the two questions is asked. One is model A is already company has installed, they're going to dismantle and buy the super model and they are going to install the super model. And second question is the company has not installed the model A, whether model A or super model which we can buy. So that is the decision making of the second thing. So here if you see, if you take the model A out of your company and bring in the super model, you will get an additional cash inflow of 20,000. So 50,000 is a normal cash inflow. Against this 50,000, we are going to get 70,000, which means incremental cash flow of 20,000. Yes. So now we will go for calculating the net present value. So net present value, if it is positive, it is good for the company. Okay, which means the overall project or the investment is getting some returns. That's why the net present value is positive. Okay, so the investment, as we discussed in our last slide, total investment is 1,10,000 that we are installing in the year 0. Okay, and it is given in the question the project life of this project life is 5 years. So I am taking year 1 to year 5 in the column basis. Okay, maybe your book has not solved in this fashion. This is only for making you to understand, but it is advisable also. You can use this same methodology in your answer sheet also. So let's go. So what is the incremental cash flow we are getting by taking out model A and bringing in super model? 20,000 is the additional cash flow that we are getting. So year 1 we will get 20, and same way every year we will get 20,000 by operating the super model till the life of that for 5 years life. Year 1, year 2, year 3, year 4 and year 5. Next, what is the terminal cash flow? They have not given any salvage, but after 5 years, what is the value at which you can sell this investment or sell this super model? Those detail is not given. So we are assuming the terminally, if we are going to liquidate this asset, there is no cash flow from that. So I'm taking it as 0. Next, present value factor, 14% is the cost of capital. So first year 1 is the first year, year 0 is present. So present factor is 1. But if you go to year 1, which means the cash flow what is generated after year 1, what is the value of that now? Okay, so how to do that? So we need to have the present value factor. So 1 divided by 1.14, because 14% is the cost of capital. 14% means 0.14. Add 1 to it, it becomes 1.14. So 1 divided by 1.14 is the present value factor for the first year. Same way for the second year, 1 divided by 1.14 into 1.14. That is for the second year. For the third year, multiply 3 times 1.14. For the 4 year, 4 times, and 5 year 5 times. So if some other question is asking you for the 10 years, you have to calculate this for the 10 years. If present value factors are not given in the question, if it is given in the question, just like that, take and put. Okay, and now you can use the calculator to find this decimal value, and I have find the decimal value here, but this is already given in the question. So you can calculate. Just I am showing you, in case it is not given, you don't get panic. You can easily calculate it with this formula. What is the cost of capital? For example, cost of capital is for 14% here, which means 0.14. Add 1 to it, 1.14. 1 divided by 1.14 for the first year, and for the every year multiply 1.14 to the denominator. Okay, and now you have got the present value factor, and 20,000 is the first year cash flow, and multiplied by 0.877 is the present value factor. So 17,543 is the present value. Okay, if you bring the value of 20,000 at the end of first year to the year 0, the value is 17,000, which is simple, like 17,000 if you invest in a fixed deposit which is having an interest of 14%, then you will get at the end of the year, you will get principal plus interest value of 20,000. So simple logic. Okay, so at the end of, if you invest in the fixed deposit at the year beginning, at the end of the year you will get principal plus interest. So at the end of the year you are getting some amount, you have to deduct the interest, then you can bring it to the present value. So like that, I am deducting the interest. The present value factor is nothing but deduction of interest portion, so that the money cash value comes to the current level. So in the year 0, it becomes 17,000. So 2 years later, if you get 20,000, it comes to the present value is 15,000. Same way 13,000. Okay, so 20,000 multiplied by 0.675 will give you 13,000. Same way 20,000 multiplied by 0.592, 0.519, you have got the present value of all the cash inflows here. You already have the cash outflow, that is already in present only, 1,10,000. 1,10,000 is the present value of cash outflow, and 68,000 is the present value of cash inflow. Present value of cash inflow minus outflow, NPV is negative. So it is not advisable to replace model A, which is already installed, with super model. Okay, this is not advisable. Okay, now the second question is also asked. We have to analyze both the machines separately. That is also very easy. Model A, what is the cash flow from model A? 50,000 is the model A cash flow. Now let's do the same NPV calculation for model A. Okay, so same calculation, the model A, cost of model A is 1 lakh and 50,000 is the cash flow every year. Apply the same logic and you can find the NPV value is 71,654. Okay, NPV is positive. Yes, it is good, but we have to check what is the NPV of super model, and which NPV is high, that is what is the better option. Now for super model, what is the cash flow? Cash flow per year, 70,000 is a cash flow. Okay, so 70,000 is a cash flow. Let's go for the super model. What is the investment required for super model? We have to invest 1,50,000 in the first year for buying the super model, and every year it will give 70,000 for the year 1 to year 5. Apply the same logic, multiply by the present value factor, find the present value of cash inflow, find the present value of cash outflow, which is 1,50,000, which is the investment, and present value of cash inflow minus outflow, you are getting an MPV of 90,316. So if you have a choice to buy super model or model A was having only 70,000 something of NPV, but super model is having 90,000 NPV. So buying super model is better. So that's what we are answering the second question. Okay, so this is what is the NPV is used for. We can analyze whichever is best for the company based on the cash inflow that is generated over the period of time. Okay, time value of money. So we are deducting the time value and bringing in everything to the present and analyzing the project at present. That is called the NPV approach. Let's do the next problem. Okay, there is a company called Tektronix Limited. Okay, manufacturer of pocket video game. Capital expenditure of 600 lakhs of capital expenditure, and working capital of 150 lakhs is required. Okay, 150, so 600 plus 150, 750 lakhs of investment is required at present stage, at year 0 itself. The company's annual production 12 lakh is the capacity. So capacity I have taken as 12 lakh here. Okay, and during the 6-year working life, so working life is 6 years, so I have taken year 1 to year 6. Okay, 6 columns I have taken. I'm going to calculate the cash flow, and the project is expected like this. The capacity utilization is going to be like this. So 12 lakh is the total capacity for the year 1. By year 1, we are going to utilize 33 1 by 3, which is nothing but 33.33%. Approximately the sales volume is going to be 4 lakh for the first year. So same way you can apply this percentage on the 12 lakh capacity and find the sales volume. So find the sales volume. Next, the company has given you the selling price is also given. So sales volume is there, selling price is there. Sales revenue is equal to sales volume multiplied by selling price. You can find the sales revenue. Okay, and contribution of 40% is given. So you have the sales revenue, apply 40% on the sales revenue, that is going to give you the contribution. I have found the contribution also. Next, the annual fixed cost excluding depreciation is estimated to be 480 lakhs per annum. So 480 lakhs is the depreciation for the 3rd year onwards. Okay, so for the year 3, year 4, year 5 and year 6, 480 lakh is the depreciation, I mean the fixed cost excluding depreciation. For the previous years, okay, for first year it is 240 lakhs and second year it is 360 lakhs. So 240 lakhs and 360 lakh I have taken it here. Okay, so fixed cost is taken. So the contribution, you can reduce the fixed cost, and we have to reduce the depreciation also, for which we have to calculate the depreciation. Now we have seen what is the capital expenditure. 600 lakh is the capital expenditure. That is the opening value of the asset in the year 1. What is the depreciation? Okay, for that we need to read the question. So average rate of depreciation is 33.33 percentage. So apply 33.33 percentage. So it becomes 33.33 percentage multiplied by 600. It comes to 200 is the depreciation for the first year. So 600 minus 200, closing value of asset is 400. For the second year, opening value becomes 400. Apply 33.33 percentage. So depreciation is reduced. Closing value of asset is found. That becomes the opening value of the asset for the year 3. Same way, reduce the depreciation for the third year, which is 33.33 percentage on 267, and you can find the closing value of asset. So same way, I am calculating for all the 6 years. The life of the investment is 6 years. So I am calculating, and the closing book value at the end of 6 years, the book value of the asset will be 53 lakhs. Good. Okay, so depreciation value you have calculated, which is T3 200 133 89. I'm taking this here 200 133 89 59 40 and 26. So 40 and 26 for year 1, year 2, year 3, year 4 and year 6. Okay, so contribution minus fixed cost minus depreciation will give you profit before tax, and in the question it is given the tax rate is 50 percentage. So deduct the 50 percentage tax, you will get profit after tax. So that is profit after tax. Depreciation is a non-cash expenditure. So we have to add back the depreciation to find the cash outflow. So add back the depreciation. So depreciation value is added back to this profit after tax, and you are finding the cash flow for the year. So many students will miss and take the profit after tax. Please add back the depreciation so that you can find the cash flow. Now remember, this is the cash flow. We will take this for the NPV calculation. So 140, 207 up to 253. This is the cash flow. So we will move to the next slide. Yes. So what are the other details that is given? So yes, depreciation values we have already calculated. Operating cash flow, yes, we have already calculated this in the previous slide. Okay, and now we are going for the NPV calculation. So 600 is the capex investment, 150 is for the working capital, 600 plus 150 total 750 is the investment in the year 0 with a present value factor of 1 because it is already in current. Okay, so 750 multiplied by 1, total outflow for the year 0 is 750. Okay, next we have already calculated the operating cash flow. I am bringing the cash flow here. So all the cash flow is brought in here, and it is also given the company needs a additional working capital in the year 3 of 100 lakhs. So 100 lakhs additional working capital is needed in the year 3. Next, the present value factors are given. You can calculate the present value factors as we discussed in the previous problem. So the cash flows and multiplied by the present value factor, you can find the present value of all the cash inflows. You can find all the cash inflows. Next, the most important thing is terminal cash flow. This is where the high probability the mistakes will happen. What is terminal cash flow? The project life is 6 years. At the end of 6 years, they will we have to think like we are diluting or we are liquidating the asset. We are liquidating the working capital. Now we are seeing what is the asset value. 600 lakhs of asset we have bought. At the end of 6 years, the book value is 53 lakhs, which we have already calculated, and it is given in the question. We are 10 terminal value of fixed asset is 10 percentage. So fixed asset at the end of 6 years, you can liquidate it for 10 percentage. So 10 percentage of 600 lakhs is 60 lakhs is the sale proceeds of the asset. But the value of book value itself is 53 lakhs, which is 52.69 lakhs. If you see, the profit on sales comes to 7.31 lakhs. If there is profit on sale of fixed asset, then income tax come into picture. So income tax is given in the question at 50 percentage. So 50 percentage on profit of sales becomes 3.65 is the income tax that is deducted. So 60 lakhs is the terminal value that we will get. In the 60 lakhs, we are deducting the income tax of 3.65 lakhs. Okay, and what is the working capital? 150 lakhs working capital in the year 0 and 100 lakhs working capital in the year 3. 150 plus 100, 250 lakhs. Working capital mostly 100% will be liquidated. So current assets can be, terminal value is 100%. So 250 lakhs you can get in the last year. Okay, so in the year 6, when you are closing the project and you are liquidating, you will get the cash flow of 306.35 lakhs. So 306 I am taking it to the year 6 and I am applying the present value factor for 253, which is the cash inflow from operation, and this is the cash inflow from terminal liquidation. Add this, apply the present value factor, and you will find the year 6 cash inflow of 241. Add all the present value of cash inflow. The cash inflow will come to 959. Present value of cash inflow minus present value of cash outflow. Cash outflow is 750 plus 66. 66 is the present value of cash outflow for the third year. 100 lakhs we are investing for the working capital. So present value of cash inflow minus present value of cash outflow, 959 minus 750 minus 66 will give you a NPV of 143. NPV of 143 is positive, which is good for the company. Okay, so let's move on to the next problem, students. The chemical company is considering replacing the existing machine. So you are going to replace the existing machine of with one costing 65,000. So the new machine which the company is looking at is 65,000. The existing machine was originally purchased 2 years ago for 28,000. Okay, so 2 years ago this machine was bought at 28,000. Depreciation by straight line method. Okay, for 7 years life. Okay, so for 7 years life, so here I have put the depreciation. So opening value of the asset is 28,000. So straight line method for 7 years, which means 28,000 divided by 7 is 4,000 is the per year depreciation. Straight line method is very simple. So 4,000 is the first year depreciation. Depreciation per year will be constant in the straight line method. So 28 minus 4,000, closing value of asset will be 24,000. That will be the opening value for the second year. The same 4,000 will be the depreciation, and the closing value is 24,000 minus 4,000 is 20,000, which will be the opening value for the year 3. Apply the same logic. At the end of 7 years, it will be fully depreciated. Yes, so we have calculated the depreciation for this machine that is already bought. Okay, it is currently sold for 30,000. Oh my god. Okay, the machine itself we have bought for 28,000. That is 2 years ago, and now after 2 years they are going to sell it for it can be sold for 30,000 with no removal cost. With no removal cost we can sell it for 30,000. What is the sales proceeds that the company is expecting for selling the old machine? 30,000 rupees. What is the purchase cost itself is 28,000 only. Okay, now we have used this machine for 2 years. So after 2 years, what will be the book value of the asset? Book value of the asset is 20,000. So purchase cost is 28,000, book value is 20,000 only, which means you are having a profit on sales 8,000. Profit on sales, you have to pay the income tax for it. What is the income tax given in the question? 55% on 8,000, which is 4,400. Okay, income tax on profit you have, but you are selling for 30,000. The capital asset you are selling for 30,000, and that capital asset is bought for 28,000 only, which means the capital gains of 30,000 minus 28,000, 2,000 rupees capital gains. On capital gains, the tax is 30%, which is given in the question. 30% is the tax on the capital gains. So 2,000 multiplied by 30%, which is 600 rupees, is the capital gains tax. So I have highlighted the total taxes 4,400 plus 600 will give you the total tax is 5,000 rupees. So 30,000 rupees you are getting the cash inflow, out of which tax of 5,000 will be deducted. So total money you will get is 30,000 minus 5,000, 25,000. So that will be the total sales proceeds we are getting. 25,000 is a sales proceed. So what is the investment required? The company is thinking of replacing the machine. What is the investment required? New machine they are going to buy for 65,000 rupees, and for that they are requiring the installation cost. Okay, they need an installation cost of 10,000 as given in the question. Okay, and additional working capital of 10,000 is also required as given in the question. Working capital requirement of 10,000 is also required for expanded operation. So that is also given here. So totaling 65,000 plus 10,000 plus 10,000 comes to 85,000, and we are going to liquidate the existing machine. That gives a cash inflow of 25,000. 85,000 minus 25,000, total investment required is 60,000. Okay, This is the first step. What is the investment required? Calculation is 60,000. Now the company expects the after tax profit. With existing machine, they will get the profit after tax like this, and for new machine they will get the profit after taxes like this. So what is the cash flow for the calculating the NPV? Cash flow is not profit after tax, profit after tax plus depreciation. Depreciation is a non-tax expenditure. So I'm sorry, non-cash expense. So non-cash expense to be added to the profit after tax to find the cash inflow for calculation of NPV. Now we will go for that. Okay, depreciation, yes, we have already calculated, we have seen this, and now we are going to calculate the NPV. So the investment required in the year 0 is 60,000. Now the profit after tax for the profit after tax is 2 lakh, and depreciation is 4,000 plus 2 lakh is the profit after tax plus depreciation of, so 2 lakh 4,000 will be the cash flow from the existing machine. So add the, so for the second year also the depreciation is 4,000, cash flow is 1 lakh 50, so 1 lakh 50 plus 4,000, 1 lakh 54,000. Same way 1 lakh 80,000 plus 4,000, 1 lakh 84,000, 2 lakh 10,000 and 2 lakh 20,000. It becomes 2 lakh 14,000 and 2 lakh 24,000. Same way for the new machine, what is the profit after tax plus depreciation, for which we have to calculate the depreciation. What is the cost of new machine? Cost of new machine is 65,000 plus what is the installation cost of 10,000 plus 65,000 plus 10,000, 75,000. What is the salvage value of the machine? Salvage value of the new machine is given as 5,000. So 65,000 plus 10,000 minus 5,000 becomes 70,000 is the value of asset. Okay, always you will capitalize the asset only by excluding the salvage value. So the asset opening cost is 70,000 and straight line methodology of 33. The straight line methodology is applied for 5 years. So the life of the asset, new machine, is only 5 years. So 70,000 divided by 5, 14,000 is the depreciation per year. It is straight line method. 70,000 minus 14,000, 56,000 is the closing book value. That becomes the opening book value for the next year. And depreciation is going to be the constant for all the years because it is straight line methodology. And the value of book value of the asset will be 0 at the end of the period. Okay, so now what we are going, so we have an existing machine, we are going to put that machine, take that machine out and consider the new machine. So which means you have to see the incremental cash flow. That's why we have taken the profit after tax of the existing machine, profit after tax plus depreciation of the new machine. So cash inflow from the existing machine, cash inflow from the new machine, cash inflow from the new machine minus cash inflow from the existing machine will give you the incremental cash flow here. So I have calculated incremental 2. So 2 lakh 30,000 minus 2 lakh 4,000 will give you 26,000. So yearly incremental cash flow is found. How to find the terminal cash flow? This new machine has a salvage value of 5,000 at the end of 5th year plus working capital 10,000 is required for expanded operation. That also we saw. So total 15,000 is the terminal we will get while liquidation of the project. So 15,000 in the year 5 we will get. Okay, so present value factors can be calculated because the cost of capital is given as 15%. Present value factors can be calculated. Apply this on the cash flow. You can find the present value of cash inflow. Present value of cash outflow you already have, which is 60,000. And for the terminal value also, 15,000 multiplied by 0.497 will give you terminal cash flow at the present value is 7,458. So 82,709 plus 7,458 minus 60,000 will give you an NPV of 30,167. NPV is positive, which is good for the company. Okay, and we will go to the next problem, which is the last problem for the session. I think this is a very huge problem. Yes, the company is considering two mutually exclusive projects. The first project is project K, require an initial cash investment of 2,68,000 of investment is required. Okay, I have taken this, the investment means the capex investment, which is you are taking the asset. Okay, so 2,68,000 is the year 0. The machinery will have a useful life of 10 years. So 10 years is the useful life and 10 years is the cash flow. You have to calculate the cash flow for the 10 years. So 10 columns I have taken. Next is the end salvage value will be 20,500 will be the salvage value. Yes, we can take that. And require additional investment in the debtors and stock, which means this is working capital 40,000. So working capital investment of 40,000 is also required. At the end of 5 years from the commencement, balancing equipment of 45,000 is required. So which means at the end of 5 years, so at the year 6 you will install this 45,000. This is additional investment that is required. The cost of additional machinery will be written off to depreciation the balance life of the project. The project expected to yield a cash flow of 1 lakh annually before depreciation. So this is cash flow before depreciation. Okay. So next is there is something project R, which we will discuss in the next slide. And depreciation is written off the company. Okay. So here it is not written down method, and it is also not straight line method. They have given some methodology, and it is really confusing. I think many students will get confused with this point. So depreciation is written off by the company sum of years digit method. Okay, this is a method they have discovered on their own. I don't know who has discovered this methodology. Okay, this is sum of years digit method. Okay, that's well and good. So what does that means? Okay, there are 10 years of life of the asset. So 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10. This is what they call it as sum of years digit. Okay, that will come to 55. Okay, and 2,68,000 is the value of asset, and 2,68,000 divided by 55. I'm sorry. So salvage value is there, which is 20,500, which is already given in the question. Salvage value is 20,500. So 2,68,000 minus 20,500 will give you 2,47,500. So 2,47,500 is the net asset value divided by sum of years digit divided by 55 will give you 4,500 as the ratio. And now this ratio will be, okay, the life of the asset is 10 years. The ratio of 10 is to 9 is to 8. So this 4,500 has to be multiplied by 10. That is the first year depreciation. So 4,500 multiplied by 10 becomes 45,000. That is the first year depreciation. For the second year, 4,500 multiplied by 9. Okay, which gives you 40,500 as depreciation. 4,500 multiplied by 8. 36,000 will be the third year depreciation. So same way the depreciation goes down as like this. You can fill the depreciation now itself, and 2,68,000 minus the first year depreciation will give you the closing value of the asset. Closing value for the first year will become the opening value for the second year. Same way you can apply the logic and fill the depreciation table. Now you can apply the same logic for the additional investment also. It is given in the question, you need to buy some balancing equipment for 45,000 and the investment will be 45,000. Same way sum of years digit. So this will have a life of 5 years. So 1 plus 2 plus 3 plus 4 plus 5 will give you 15. So this is not, this asset is not having any salvage value. It is given in the question. So net asset value is 45,000. 45,000 divided by 15, sum of years digit is 3,000. So 3,000 multiplied by 5 will give you 15,000. 3,000 multiplied by 4 is 12,000. 3,000 multiplied by 3 is 9,000. 3,000 multiplied by 2 is 6,000. 3,000 multiplied by 1 is 3,000, which shows that your calculations are correct. There is no salvage value. Okay, so book value of the asset itself becomes 0 at the end of the year 10. It is installed only at the year 6 and then it goes to year 10. Okay, so we have calculated the depreciation also for the additional equipment. Now this is the cash flow which is given in the question. Before depreciation is 1 lakh for every year, and depreciation for the original investment we have here depreciation value here. I'm taking it to the taking it here. Same way for the additional equipment you have the depreciation of 15,000 to 3,000. I'm taking it here 15,000 to from year 6 onwards to year 10. Now cash flow minus depreciation of the original machine minus depreciation of the additional machine balancing equipment will give you the profit before tax. Tax rate is given in the question as 50%. Reduce the 15%, you will get the profit before tax. Add the depreciation to the profit before tax. Here you have two depreciation, which is the depreciation of the original equipment and depreciation of the additional balancing equipment. Add these two to the profit after tax. You can find the cash inflow. So cash flow for this project K can be calculated. So you have all the detail. You can go for the NPV calculation. So the NPV calculation is investment is 2,68,000 for working capital. You need 40,000 for balancing equipment. At the end of year 5, you need the 45,000. So for the cash flow, just we have calculated in our last slide. So all the cash flow from year 1 to year 10 has been taken. What is the terminal cash flow? Is the liquidation of all the asset. The new machine you can liquidate at 20,500. It is given in the question. Working capital can always be liquidated at 100%. So 40,000 investment can be liquidated at 40,000 investment. So okay, so total is 60,500. So 60,500 during the year 10 you will get. Present value factors are given in the question, so you don't have any issue. I have taken all the present value factors, multiplied the cash flow. You can find the present value of cash inflow. You also can, okay, 2,68,000 plus 40 becomes 3,08,000. That is the cash outflow, and 45,000 is a cash outflow multiplied by 0.48 will give you 21,600. That is a cash outflow. So you can find the total present value cash outflow. Same way you have all the present value of cash inflow here, and also terminal value 60,500 multiplied by 0.230 gives you 13,915 as a terminal cash inflow, and also all the present value cash inflow is totaled to 3,21,123. So present value of cash inflow minus outflow will give you a NPV of 5,438. So project project K is giving a uh, NPV of 5,438. What is the next project we are going to analyze, which is the project R? If it is giving more NPV, then project R will be better. If it is giving lesser NPV, project K will be better. Now let's go for analyzing the project R. Okay, so project R is giving project R alternative under considering investment of 3 lakh is required. So asset opening value is 3 lakh, and same way apply that depreciation logic. You have to find the sum of years digit 1 to 10. 55 is the total, 3 lakh is the asset cost, and they have given a salvage value is expected 25,000. So reduce the salvage value, you can find the net asset value as 2,75,000. So 2,75,000 divided by 55 will give you 5,000 as the ratio. Now 5,000 multiplied by 10 will give you 50,000 first year depreciation. 5,000 multiplied by 9 will give you 45,000 second year depreciation. 5,000 multiplied by 8, 40,000 third year depreciation. Here also the asset life is 10 years. Also for the cash flow I have taken 10 years because it is given in the question. The life is for 10 years. Take 10 columns. So depreciation you have calculated, and it is given the cash flow of 80,000 per annum before depreciation will be for the first 5 years it is 80,000. So I have taken 80,000 for the first 5 years, and for the remaining 5 years it is 1,80,000. Now depreciation you have calculated, which is 50,000 to 5,000. I have taken it here. Add the depreciation, reduce the depreciation, you will get the profit before tax. Reduce the tax 50% as given in the question, you will get profit after tax. For finding the cash inflow, profit after tax plus depreciation. So you can add the depreciation and you can find the cash flow. So cash flow is calculated here. Now we have all the detail. Let's go for calculation of the NPV. 3 lakh is the investment that is given. Working capital investment 40,000 that is given. And cash flows, just now we have calculated all the cash flows I have taken. What is the terminal cash flow? Salvage value of this project R machine is 25,000. Working capital 100% it will be liquidated at the end of the project. 40,000 plus 25,000, 65,000 is the total terminal cash flow at the year 10. So year 10, 65,000 I am taken it here. Present value factors are given in the question. Multiply by the cash flow, you can find the present value of cash inflow. Okay, 3,40,000 is the total investment that is brought in here. 3,40,000 is brought in here. And what is the cash inflow? All the cash inflow for all the year plus terminal cash inflow 65,000 is also a cash inflow for the year 10. So total cash inflow is 3,50,825 plus 14,950 minus cash outflow is 3,40,000 will give you 25,775 as NPV. Okay, project K was having 5,000 and odd as NPV, and project R is having 25,000 NPV. It's a higher NPV, way higher, 5 times higher. So project R is better. All the very best guys. Meet you in next class soon. Thank you.